All right, guys, welcome back to the Market Delta Footprint Deep Dive. This session is going to be on the footprint filter. As we continue to follow the footprints to profits, I want to remind everyone, that it's a building block process. As we go through this, if you don't understand some of the core simplicity of why these numbers, why a lot of what the footprint shows us is important, some back of the hand type of moments, it's going to be really difficult to build on it, just like in anything else. So just to work towards an agenda page, I actually slid an agenda page in for this session because I want to make sure people go over these questions. When you're learning order flow, often people that educate or teach it don't know the right questions, and then traders don't know what the right answers are if they don't know the right questions. So what is the footprint filter? We'll go over that, and why would it help? Some additional questions of what to ask yourself after you see these instances of bigger buyers and bigger sellers, aggressive buyers and aggressive sellers that are bigger than normal, and we're filtering it out to find that. So as I go on, I have to start this with my family because you missed it the first time. My father on the left, me on the right. He always told my brothers and I, if you know how, you'll have a job. If you know why, you'll be the boss. We continue to go over the why markets do what they do, using the footprint as a tool to read order flow in these segments in this footprint deep dive program. So the other thing that's important, bird in the sky, if it left a trail, what the heck would it look like? The bird right now is where price is right now. The trail it would have left is where it came from. Rotation, how to visualize. I can't stress that enough. If my own son was trying to learn how to trade, this is where I would start, making sure your eyes fixate on a chart the right way. So when we take a candle and we pull it into a footprint like we did on previous sessions, you see the aggressive sellers on the left, sell market orders, and then aggressive buyers on the right, which are buy market orders. We went through that in the previous session that I did on thin spots and rotations. Now we're going to strip it down into additional information, and that is the filter. When you see a red number, it's aggressive selling that happened to be above around 200 is what I would have had this filter set for. If you see a green number like you do here at the bottom, it was for greater than 200, greater or equal to 200 roughly. These are examples of the S&P E-mini futures market, and around 200 in my opinion is deemed to be pretty decent size for that market. Different sizes, different filter numbers for different markets we'll go over, like crude oil is going to have a different number than the S&P E-minis. If you set crude oil for 200, you'd never see anything in the filter. You'd see 0 by 0. So everywhere you see 0 by 0, that means there was not big size that was executed at any particular price. There was here, 247, must have hit the bid for big size, and there was down here, 200. Must have lifted the offer with big size. Now, you got to remember, the way that data is reported, this isn't necessarily one person. Could be technically 247 one lots that came in and hit the bid, but what they did was they hit the bid at the same exact millisecond. That's important because whether it's one guy or 247 one lots, it's a lot of selling at one particular moment. The questions we start to ask is, what happened? We'll get into that in a moment. What happened? But this is the filter of what we talked about in previous sessions. This would be every contracts that trade at particular prices up and down the order book. And this is filtered for just bigger size and bigger contracts. So as we move towards building a story, we show a platform. This happens to be Market Delta Cloud, but most platforms, as I said before, have similar functionality. We throw up a chart with the footprint. What are the first things we want to look at? Rotations, right? Up, down. Hopefully by now, at this point in your progression through the deep dive, you're looking at these footprints in some sort of rotational fashion. The other thing is, what could happen if you recognize a thin spot? Number one, where would the thin spot be on this particular chart? I'll give you guys a couple seconds to answer that. It would be right here. Exactly. That's one of them. pretty clear to see that it's thinner in that area than it is in other places. So if you said inside that yellow circle, you would have been correct. So now let's move towards adding and building out this story. Up, down bars, as I like to show again and again because it's important. Let's add a filter. I generally put my filter at the bottom of my unfiltered chart. So if my unfiltered chart is up here, and you'll see that when I go to my desktop shortly. But the unfiltered chart is up here, and the filtered chart would be down in here, showing you aggressive buyers and or sellers and what price they would have come out at. So I'm going to tell you a couple things. When it's green again, it's aggressive buying of over 200. Aggressive selling would be colored in red. If there is no color, like you see in this example, you don't panic, but because there is no imbalance, because it happened to be across prices, it wouldn't shade green or red. Still important, still big size, and they're active. The only reason why it's not red or green is because the relationship diagonally is offset with bigger buying / bigger selling. All right? So it's just a function. You don't see that often, to be honest with you. That's a very rare, not very rare, but a rare occurrence that you'll see that in your filter. I had this bull drawn with long horns just to try to give you guys a good visual and help with your memory to show support. Why? When big buying comes in and the market goes up, it's often subsequent real-time support. All right? So not only did a 200 lot come in the middle of his horns, but it was backed up by another 200. And most likely shot up when this 200 lot came in. So you've got a sequence where you've got 3 200 lot orders come in within a few tick area in this particular example. You also could see that the market went fast if you looked at the unfiltered chart up in here. That was our thin spot I asked you about a moment ago. What does thin spot show you? Moments where the market might have moved fast up or down, in this case up. What happens when a lot of people, or what happens when a market moves up fast? People did what? They miss buying or selling? Buying. And if they miss buying it and they get another attempt when it reapproaches where they missed it, they're going to probably be begging to buy it, which is the definition of support. It has to be a dynamic that's back of your hand. You can't go in either deeper into this deep dive or deeper into your trading careers without understanding the true definition of why support would work and why the true definition of why resistance would work. And it's people who missed prices trying to get long or buy it rather where they missed it. All right. That's why these thin spots, and where in a lot of ways the big buying or selling kicks off this speed, is important to recognize. So the filter, again, showing you, and you could adjust it. I'll show you on our charts on the Market Delta desktop how to adjust these numbers so you can get more or less, or if, you know, especially if you're trading a different market than the S&P minis, you're going to want to adjust it accordingly, because you'll never see anything if you had gold or oil or the NASDAQ adjusted to 200 or more. So as we build this out, you could see, like I mentioned before, what are some very important questions to ask. First off, should be simple, the recognition. Most people who will watch this video that are unfamiliar with the footprint didn't recognize these instances. So now you put yourself in a position where at least your recognition is present. You know, you got to know what the deer looks like in order to have a shot at shooting it. Then the proper questions to ask. This is where a lot of order flow educators go wrong. They'll teach a lot of what order flow might mean, a lot of them, and I'm not bashing other educators because there's some good ones, but from feedback I get from other people that I help, they don't really give a clear understanding. They might understand how to read order flow, but if you can't convey it really well, it's going to be difficult for you to have value to people that learn. So what's really important for people that learn from me isn't the fact that I've traded successfully for 17 years, and it's not the fact that I can communicate well. It's the fact that I could do both. Therein lies the value. So I'm bringing this up because it always reminds me of the difference between this type of order flow education and others. The proper questions to ask. The next point here on this slide is, did the big size move the market? And I'm going to get in with a story and a metaphor in a second, but that's an important question to ask. Did the size that you recognize move the market in the direction it should have? If yes, it could often be real good near-term support or resistance. Support if it was big buying that shot the market up, resistance if it was big selling that shot the market down. If not, it becomes this metaphor and story of punching a guy in the face. What does that mean? I do this with stories so you guys never forget it. I'm a big boy now. Age-wise, right? I used to, if I punch a guy in the face and he didn't move, I'd stay and get my butt kicked. Now I'm smart. If I have to punch a guy in the face and he doesn't flinch, I'm running the other way. So what does that mean in the market? What kind of predictive skill could you have when you see one guy punch another guy in the face and the guy doesn't flinch? You could start to assume accurately what might happen. So if you get big buying that comes in, little buying, and then bam, this big buyer that comes in, and the damn price doesn't go up, and it should, it's a look out below moment with this kind of facial reaction that you often get on how when big buying comes in and the market can't go. Oftentimes getting the market to move lower. You get that exodus. After you buy it, you're a seller. After you buy it, you're a seller. After you sell it, you're a buyer. Always remember that phrase. When a big buyer comes in, can't get the market or the price of that market to go up, they have to sell to exit. This creates qualification measures in resistance zones, for instance. And I'll talk about that more over a live chart. But let's go over a chart right now and blow up the filter. Like I said, below my unfilter is a filter, and this is just for about 200 or more. If I right click, we'll find exactly what it is filtered for. 189 to be exact. That's under threshold here on the Market Delta desktop. So any size that at the same moment in time lifts an offer or hits a bid at or above 189, it's going to show up on our filter. If there's a couple 200 at the same price, it'll show up as 400. So not all of these are one order necessarily. Could be a couple. What we're trying to look for as we trade is to constantly build a story out that's going to overlap with what you're looking to do. Any one of the videos and sessions in this program or any other program is not going to make you guys $1 million. But if you stick with what you're trying to learn and put everything together, you're going to give yourself the best chance at it, to build out the story that you're trying to tell yourself. So if you're looking for a moment to get short, by all means, you probably would have missed selling it here because it moved pretty fast. In what direction? Oh, by the way, let's go back and say bird in the sky. Bird in the sky, if it left a trail, what would it look like? Right? Eyes got to get fixated that way, no excuses. So if you're looking to get short, which means you're bearish in this moment, it's easy to say when you look at a chart after it's already filled out, yeah, I'd like to get a short up here. It'd be great. I'd take my profit down in there. That'd be a great target. Everything is perfect. It's not that simple, and you guys have traded for probably any more than 5 minutes know that. But after you get better at reading the real time is how you gain your advantage over others. When you see a triple stack, doesn't have to be a triple stack, but when you see the amount of selling that you get inside this yellow circle, again, are you going to be able to sell it in here? Probably not. But going off the premise that if it did move fast, you've seen some bigger size and bigger players that might have come in, could it be subsequent resistance? Now the effort is, I know where I'm going to get out if I get short, and I got a pretty good location to get short. Don't get too scientific to say, where should I play it? Right in the middle, a tick above it, tick below it. You will understand where to play it. But now, before you see the direction already play out, like you do anytime you look at a chart and try to learn from it, but before you see that, now you've got a sense of when it happens. Here's the breakout. Here was the previous consolidation. It's coming back to test the breakout before breaking back to the lows of maybe the session. What you're seeing is what? People who miss doing what inside that yellow circle? Selling it or buying it? Did more people miss buying or selling it? I'll give you a couple seconds to answer that. They miss selling it. If people miss selling it, there's a good chance that they're going to try to sell it if they get another chance inside that area. Now, take a look at, that was the example of if big buyers, or in this case sellers, get the market to go in the direction it should, it's subsequent resistance. That's the example on a chart from late August, the S&P minis. All right. Now here's an example of big buying that comes in and you're not seeing it rally. Rule of thumb is it should rally in a pretty timely fashion. You know, if after a couple minutes go by, if the damn thing hasn't rallied, look out below. This market's pretty damn weak. This is the punch a guy in the face and he's not flinching. The market's getting punched in the face with big buying and they can't get it to go up. Now your predictive skills are actually a skill. The randomness is being stripped out. The direction of the downside is easier to call, and it doesn't feel like a guess or that you got lucky to make that trade or to have that opinion. So this was the punch a guy in the face and he can't get the guy to fall down or even blink. Where's the market going? Probably down. Another example only on the opposite side, where in a moment this big seller of 264 here on the left of your screen gets the market to go down, but only a tick or two. When it gets back through it, they rush it back up about 1.5 points higher. And it's used as subsequent support until it's not. Then it becomes resistance. Now you're following the market the right way with using order flow to, when you're properly recognizing order flow, properly asking the right questions. You're reading the real time just like a quarterback would when he walks up to the line of scrimmage. You're not just practicing on Monday, Tuesday, Wednesday, Thursday, Friday for game on Sunday, and then your recognition skills go way down when they should go way up because the game started. This is important, and not just the recognition. Obviously, that's important. If you don't recognize it, you're not going to be able to read. But the right questions to ask yourself in that process. Now, let's go back a few moments and take a look at some other instances where you see some examples of this. So you guys, I mean, I just go back without, not pulling, cherry picking stuff, but just go back arbitrarily and walk through this. You don't see anything, it's probably because of the overnight session. Oh, here we go. Big buyers come in and the market is struggling to go up with that 200, probably going to be overhead rotation, and it was. That 386 got it to go up, probably some small support, and it was. 200 lot gets it to go down a little bit. As soon as it gets through them, it's gone. This is still an overnight session, but it's a way to go bar by bar and start helping yourself practice at the same time prepare. Let's get into more of when the market opens up. Nothing's going on. It's choppy. It's very sloppy. Take a look at this 200 lot activity at 49.5. So to the right of it is where this activity would have happened. 49.5 and 50 even. A pair of 200 lots came in. Should it be support? Yes. And look at it. Comes in. It is. Then you get a seller, can't get it to go down. Really perpetuates the upside. So not only the skill level of recognition, the skill of asking the right questions, but now the ability to have the opportunity to build out the story, to qualify everything in one breath. Are you going to be able to get long for this breakout? Maybe, probably not, though. It's going to be hard to catch it right there for the upside. But if you could find a good spot to get in on a pullback, not only does it give you location, but it gives you a little bit below there where the hell to get out if you're wrong. That's where people are weak at. Let's face it. We're humans. So we have trouble getting out of things when we're wrong, whether it's trades, an argument about sports in a bar, or an argument with your spouse. That's the toughest, to admit that you're wrong. And so with trading, it's taking losses. So when a trade goes your way and you don't have a plan to get out, and it's a solid plan and you're okay with it, you're going to find every excuse in the world to avoid being wrong. But if you have your first target to be your stop loss, that's way better than having your first targets to be your winner. I'll tell you a story because it's important to convey this stuff. Anytime, pretty much in my life since I became a trader back in April of 2000, I was from the floor before that. But when I really started to get successful wasn't until my prop days and electronic trading exposure, which was April of 2000. But ever since that moment when I would tell people, this happened a few times, that you trade commodities if you're at a party or you're somewhere, the first thing that they ask, because they don't really understand the business, is, hey, you trade stocks, right? They go right to stocks. What stocks do you like? And I'm like, well, that's not really the space that I'm in, but they want to tell you right away what stock that they are in. This doesn't happen a lot over 17 years, but it's happened. And they want to tell you what stock that they like or bought on a tip or whatever. And these are novices. They're excited because they bought it. My first question and their first answer is, well, where are you going to get out? They tell me what the stock is and where they got in. Let's say it was $5. Well, where are you going to get out? And their first answer is always for a winner. Well, $7. A friend said it's supposed to go to 10, could double, could go to 15, might go to 50. How about if you're wrong? They go silent. They don't have a plan for that. Now, they're not professionals, right? They're retail investors. So they have an excuse not to have an exit strategy and a right answer for that question. But you guys, those that are investing in your education and trying to be better at this, if you already are successful, or just trying to get successful if you haven't been, trying to get consistent, you don't have an excuse for not having an answer to that question. You need to know, you need to know where you're going to get out before you get in. For a loser, manage your risk. That's managing your risk before you take it. That's what's important about good areas. It's not just a location to execute, but also a place to get the hell out if you're wrong, without the whole world having their stops there. Because if you're in with a bunch of other people with your sell stop, it's going to get elected. That's a topic for a whole nother webinar altogether, but we'll stick to the footprint for this deep dive. What I want people to do, because you're part of this program, if this was just a free webinar or something free or whatever else, I don't take that same vested interest in those people's success. But for people that invest in this education, I really try to get them to do something from an exercise standpoint. Exercise in trading isn't demo trading. It's trying to strip down some of the skills you've learned and see if you could recognize it yourself. So what I encourage people to do is to do what I just did. Go back to some arbitrary moment in time and go one bar at a time. Make sure you understand your periodicity, right? Go one bar at a time to see if you could make calls of where the market could go, stop, go the other way based on that recognition. It's going to build your confidence and open your eyes. And I think it's something that a lot of people don't do, even when I recommend it. So further separate yourself from the people who also invested in this program but won't do that. You want to get fit, you're going to have to sweat. You're going to have to put in some effort. You want to get and stay successful, you're going to have to put in more effort than just watching a video. If you ever go to a professional practice or training camp, they're not playing the game. They break the game up into drills. You can't find that in education out there. I've done that. I do a little bit of it here in the Footprint Deep Dive, do a lot more of it in the whole Comprehensive Edge course that's on this same website. Exercises, drills, community. Exercises, drills, community. You're not just working on a drill by yourself. You're doing it with others, and so you can reflect on it and ask questions. If you look at any kind of professional environment where they're exercising or where they're practicing, they don't just have practice game the whole practice. They break the game down. And they surround themselves with people who are like-minded. All right, so let's get into a little of the mechanics of this, meaning changing the periodicities. Always right-click, at least for the desktop on Market Delta. If you right-click into the footprint and go to Modify FP, left-click that, it'll bring you to these parameters. So the style is in balance, we know that. The threshold is 189, I showed you that. The amount of imbalance is 2,500. If we change this number higher, we're going to see less. We're going to see less instances, right? So let's change it to 500 and hit OK. You don't see any. You see this guy here. And rule of thumb is, obviously you'll see a couple in here. The rule of thumb is, when you have very little instances where they pop, now your filter number is too high for that particular market. So this isn't showing us enough. We need to lower it. That's where I come up with the 189 number. It's a nice sweet spot for the S&P minis. Okay. Now we could go to crude oil, which is this guy in here. And we could right-click to find out what our parameters are, threshold of 29. And I think that might even be a little too high. So we lower it to 24. Click Apply. Maybe a little bit better. Let's lower it to 19. I like to go one below the round numbers. We go to 19, hit Apply. This is going to show us more and more. If we wanted to see less and less, we go up. Let's go to 34. You see a little less. Let's go to 44. You see even less. Let's hit OK and drive this thing back a little bit. This is crude oil, by the way. I'm going to do this again. Big rotation up, big rotation down, chop, rally, rotation, bird in the sky. So these are orders based on 44 or greater, right? And so we could go and see some really big selling come in here. Does it work as overhead resistance? A little bit, not great, but remember, these are only 1 or 2 pennies wide. So the market comes up to there, stops, rotates down about 10 cents, then it blasts back through there. So it got choppy around that level. It worked. You don't get your face ripped off if you play it, but it wasn't a perfect rotation back down to the lows, right? You want to always have another reason to sometimes get in it and not play every one of these instances. You drop down to this 100 lot, which is a big order. It does hold for a couple rotations underneath it. Not that awesome, but pretty decent, right? The other thing I like about this, and I get into this in our Edge Zone videos as this program goes on, because remember, this program is built out. We're showing you why and allowing you to recognize it with the right questions. But as you go through this program, you're going to see better visuals, so you miss less. That was the whole key. I want people to miss less, but you got to learn why they might work and understand that, before they're going to have any value for you. You can have the best visuals in the world, but you got to understand the dynamics behind it. So the point I was going to make is I see a big seller come in right here. I expect it really to hold as overhead resistance. When it doesn't, I'm bullish. If it's a good level, I'm bullish. I expect this level to hold because of all the series of buying that came in. What price is that? That looks to be around $47.38 a barrel. And look at that, $47.38 a barrel comes in, they stop, they rally right off of them. I expect a series of all these green buyers to be support, and they come right in and they rally off of them. This is real. This is back up to where it is now. You could see a big buyer come in, can't get the market to rally. Where does it stop? Right where he got stuck. Right where he punched the guy in the face, right? Big buying kicked off a rally, comes back, doesn't work that great, comes back through it a little bit, chops sideways, but you don't have to get your face ripped off if you did buy using these two big orders as support. Big seller comes in, as soon as it gets above it, off to the races. He gets stuck. I just close my eyes, and this is like what I'm trying to get you guys to do, is the exercise of going through these to see how they might work for you. You know, let's get rid of this 47.38 down here. So if you're going through it one beat at a time, I'm looking at the right side. All right, the right side of your screen share, the right side of my chart. Big buyer can't get it to go up. Doesn't surprise me. Goes down. Same thing with that guy. Can't get it to go up. Probably rotate back down. Big buying can't get it to go. Can't get it to go. Finally, you get some big sellers and it rallies. So for me, I'd actually be like, it can't go, but they keep coming back in. I wouldn't have anticipated this rally. Now, I would have looked at it and said, I wasn't necessarily bearish either. I would have looked at it as consolidation. We are going to have buy stops above here or sell stops below there. If you draw this let's draw this better than that. This is the high of the consolidation. This is the low of the consolidation. And these are other things you'll pick up on to practice and work on, is by doing this. You're not just looking at big orders, but it reminds you to review and say, hey, this is a consolidation range. Buy stops above it, sell stops below it. Again, I could do a whole webinar. We'll talk about patterns that will explain a little bit about this in another session of this deep dive. So where do you think? Were these stuck shorts? Probably somewhere in here. This 47.97, I would imagine, would be some support below. Well, it is, and then they take it out. Now there's resistance above there or at that price. What the hell time is this? Oh, this is right at 22nd. This is right at 9 o'clock. And we didn't hold this, and I'm not making excuses for why it didn't hold, but we didn't hold this because it was pretty negative news that came down the wire on this particular date that drove stocks way lower, and it pulled energy with it. So it's obviously important. That's one thing you're not going to be able to do when you review, unless obviously you're trading every day and you're keeping track of those moments. Buy stops above that 48 on the right side, probably be support. When it's not, it chops. Stuck 75 lot. These guys are stuck at the top here. $50 lot comes in. It'll chop between those two 50s. Buyer gets stuck. These two big buyers can't get it to go up. Comes right down. 222. Take a look at this. Does this surprise you that this market comes down? There's a little delay in what I say in this chart going forward or vice versa, but there's 222 lot buyer that you can't get it to go up. It's just sitting here. If you're not getting a pop pretty quickly after seeing this kind of buying come in. 222 is a really big size, real big order in crude oil. You could expect some weakness, and you get it, and then you get more of it. So this was a moment of, you're getting a lot of buying coming out in this market, and it can't kick its rear end up in those sequences. So it starts to qualify if you're bearish for another reason. What's cool about this deep dive is, like I said in other videos later on, I'm going to talk about how to qualify these even better with using them in tandem with other things. So this isn't just something in a vacuum to use, but a very important, part or add-on to have. I want to make sure that everyone, look at this 144 overhead resistance. I want to make sure everybody has kind of a handle on things that you can do after you leave some educational moments. If the people that are helping you work your way through that education aren't giving you some things to kind of look at and work at so you begin to gain confidence to do it, then the education isn't like a full circle. And I think that's really important, to be able to come to a place where you're taking that opportunity or recognition, I should say, into confidence. All right. So I showed you how to adjust the size. Again, it's under threshold. We could take it to moments of, let's say, 99. And apply it. Go to real time here. You don't see much. Big seller gets it to go down, holds his decent overhead resistance. Big seller can't get it to go down, right? Punch a guy in the face, somewhat strong for a little bit, then sells off. He gets stuck, shoots us higher. He buys us, comes back down, support. I'm just going over each instance. This guy comes in, neither here nor there, can't get it to go down, can't get it to go up, ends up rallying out of the hole. Is this great? We went over this example, great resistance. Not really, but you don't get your face ripped off. Let's get rid of this 47.90. Again, I refiltered this for greater than 99 in crude oil. You're not going to see too many instances. This is around 1:30 Central Time, which is when crude oil is about to close. So you always see an uptick in activity right into the bottom of that hour, which I believe was right in here. You could see this selling some decent overhead resistance. This is choppy, right? 100 lot buyer, can't get it to go up. He does, comes down, seller, buyer, back and forth. Anybody that's traded any market, you get into a lot of sloppy trade. Sometimes this will help you keep you out of that. I think you guys get the gist of it. Go back to an S&P minis. If you go too high and you don't see any instances, you're going to have to take your threshold lower. If I went to 49, which is everything greater than 49, you would see a lot more reds and greens. To me, a little too noisy, right? That's why I like 189. Nice sprinkling of not too many, not too few. So remember, when reading order flow, there's always important questions to ask. Most people don't know what those questions are, let alone know the right ones. When you recognize big buying and selling, it should drive the market either up if it's buying or down if it's selling. If it's not, that's where the clue is. When the guy you're playing poker against isn't doing anything different, it's hard to read him. When he touches his head and it seems like he bluffs every time he does that, that's a tell. That's what separates the good poker players from the not so good poker players. These are the visuals that are helping you find out when the market might be overdone, too expensive or too cheap. When big buying can't get it to go up anymore, it might be too expensive. Sellers are absorbing it, and it could drive price the other way. Hopefully you guys have learned a lot as we build through this whole course as far as the dynamics of why markets move. It's very important to me that you know why. and the why is more important than the how. See you in the next video.